Hello and welcome. Today, we're going to demystify something that sounds really complex: corporate risk management. We're going to break down exactly how massive organizations try to see the future, or at the very least, get ready for it.
So here's the big question, right? How do these huge, multi-billion-dollar companies see trouble coming before it actually hits? I mean, when you're dealing with operations all over the globe, thousands of people, trillions of dollars, you can't just sit around and react to problems. You have to get ahead of them. So how do they do it?
Well, the answer is actually pretty intuitive. They build a dashboard. Seriously. Just like the dashboard in your car tells you your speed, how much fuel you've got, if the engine's overheating, a risk dashboard gives a company a live, real-time look at its own operational health.
Okay, so here's our game plan. First, we'll dig into this dashboard idea. Then we'll look at the key indicators that make it work. After that, we'll explore the strategy behind it all. And finally, see how all this data gets turned into actual decisions.
So, what's really powering this corporate dashboard? Well, it all comes down to metrics. Very specific, measurable data points that act like all the different gauges and warning lights. At their very core, these indicators are just that. They're metrics. They are carefully selected stats that, when you track them over time, give a company a really deep understanding of where they might be exposed to risk. You can think of them as the raw data that feeds this whole system.
And this data basically comes in three distinct flavors. You've got key risk indicators, or KRIs. Those are your early warnings. Then there are key performance indicators, KPIs, which tell you just how big your operations are. And finally, key control indicators, KCIs, which tell you if your safety nets are actually working. We're going to unpack every single one.
Let's start with KPIs. Now, you could argue these are the most important gauges on the whole dashboard, and that's because they're forward-looking. They're designed to be that early warning system, flagging potential trouble way off on the horizon.
What's really crucial to understand is that KRIs don't just ask if something bad happened. They break risk down into these key dimensions. How often does something happen? That's frequency. When it does happen, how bad is it? That's severity. And what's the total damage in the end? That's the impact. This multi-layered view is absolutely key.
To make this feel a little more real, let's just look at a bank's loan department. A KRI isn't some abstract thing. It's a specific number. Is the average time it takes to approve a loan starting to creep up? That could be a sign of problems in the process. Are fraud cases ticking upwards? That's a direct warning light. See, these numbers tell a story before a huge loss happens.
And the same logic applies right across the entire organization. In an IT department, KPIs might be tracking things like system failures or calls to the help desk. A sudden spike in those numbers doesn't mean a catastrophe has already happened. Instead, it's a clear signal that the system is under stress, and that risk is going up. This is what proactive intelligence looks like in action. But of course, you can't just measure anything. A good KRI has to be chosen really carefully. It needs to measure the right thing, something that actually helps you make decisions. It has to be quantifiable, ideally in dollars and cents. It needs to be precise, and it has to be based in reality. Without those things, a KRI is just noise, not a useful signal.
Okay, so if KRIs are the flashing warning lights, what are the other gauges for? Well, that's where key performance and key control indicators come in. They give you context, and they measure how well the company is actually handling its risks.
And right here, you can see their different jobs side by side. KRIs look for the causes of risk. KPIs measure the scale of your business. And KCIs measure how good your safety nets are. It's how they all work together that's so important. For example, a rising KPI, more business, without a strong KCI is a massive red flag.
This quote really hits the nail on the head when it comes to KPIs. Basically, the more business you do, the more opportunities there are for something to go wrong. It's that simple. KPIs measure that scale, which gives you vital context for the warnings you're getting from your KRIs.
And finally, we've got KCIs. You can have all the safety rules in the world, but are they actually working? KCIs answer that question. A KCI might track, say, how many times an unauthorized user tried to get into a system and was successfully blocked. It's not just about having a control, it's about proving it works. This is the gauge that tells you if your brakes will actually stop the car when you need them.
Okay, so we have all this data from our KRIs, our KPIs, and our KCIs. But data without a plan is pretty much useless. This is where the strategy comes into play, turning all those numbers into a real master plan for managing risk.
The core strategy here is something called business process mapping. It's basically about creating a super detailed flowchart for every important thing the company does. By mapping out a process step by step, you can see exactly where the risks are and where you need to put your controls. Take a look at this simplified approval process for a new product. See how risk management isn't some afterthought? It's a formal required step right in the middle of everything. They're the ones who have to review the idea, suggest controls, and create the KRIs that will be used to monitor this new product before it even gets a final thumbs up.
And what this shows is that risk management is a continuous cycle. It happens before an event, through smart design and prevention. It happens during the process, with ongoing monitoring using our indicators. And it happens after an event, with good incident management to limit the damage and make sure it doesn't happen again.
All right, let's bring this all together now. We've seen the indicators, those are our gauges, and we've seen the process mapping, that's our master plan. Now, let's just step back and look at the big picture of how this whole system works. Ultimately, all of these tools, all these metrics, all these processes, they all come together for one single goal: clarity. The entire system is designed to give a company's leaders a clear, real-time picture of their risk so they can make smart decisions and protect the business.
So, the key thing to take away is this. The three types of indicators are the gauges that give you the data. Business process mapping is the master plan that tells you where to put those gauges and what they mean. And together, this system changes a company from just reacting to problems to actually getting ahead of them. It's proactive.
And that leaves us with one final question to think about. This whole sophisticated system, it gives us incredible insight. But is it a crystal ball? Can it perfectly predict the future? Or is it maybe just a highly advanced rearview mirror, helping us react faster to things that have already started to go wrong? The answer is probably somewhere in the middle, and that's what makes this whole field so challenging and so important.